155 minutes. That is how long it took for the paper markets to delete 5 days of physical gains. While the headlines were screaming about Iranian drones and US carrier groups, the screens in New York were doing something far more calculated. Last week, the signals were unanimous. Kinesis was trading at 100, Hyperliquid was at 96, gold was punching through $5 400. Every physical-backed metric told us to expect a massive gap higher when the COMEX opened. And it happened. We saw $97 silver in the pre-market. We saw the stampede we predicted. But then, someone said, go down. Despite 15 countries being struck by Iranian munitions, despite the largest refinery in Saudi Arabia going dark, and despite China literally running out of gold bars, the price was slammed back to $88. Today, we are going to look at the why. We are going to look at the regime dynamics of a growth shock, and why the paper shorts are fighting a losing battle against a physical reality that has already left the station. Drop Crucible in the comments. It tells me you're not a spectator. It tells me you're a predator. Let's look at the front lines. Let's start with the geography of the collapse. This is no longer a regional skirmish. As of March 2026, Iran has struck 15 different countries or military installations. Count them: Israel, the UAE, Saudi Arabia, Qatar, Kuwait, Jordan, Iraq, Bahrain, Oman, Syria, Cyprus, plus French, Italian, and British positions. This is a multi-front military engagement hitting the jugular of global energy. Saudi Arabia's Ras Tanura, the largest refinery in the kingdom, processing 550,000 barrels of crude per day, is effectively offline. In Qatar, the Roslafen energy complex has halted LNG production. Qatar represents 20% of the world's liquefied natural gas supply. That supply is now frozen. European natural gas prices exploded 47% in a single day. That isn't a fluctuation, that is a systemic heart attack. In Kuwait, air defenses just shot down 3 US F-15E fighter jets. The US has canceled 41% of all scheduled flights in the Middle East. President Trump has stated publicly, we haven't even started, the big one is coming soon. We are looking at 30% of the world's oil supply being physically disrupted or held hostage in the Strait of Hormuz. And yet, the price of oil gapped up and was immediately sold off. It drifted from $73 back to $70. Ask yourself, how does 30% of the world's energy disappear while the price goes down? The answer is the same for oil as it is for silver. Paper suppression. They are trying to hide the fire by breaking the thermometer. While New York was busy slamming the paper price, China was entering a state of total physical panic. This is the data they don't want you to see. Jingdong Finance, the massive e-commerce platform, crashed this morning under the weight of gold buyers. A country with 336 trillion won in savings tried to exit the door at the same time. Every major Chinese bank is reporting a gold buying rush. Physical gold stores across China have officially run out of investment bars. They are now only selling craft gold, decorative items, at the equivalent of 6,129 per ounce. Compare that to the Western spot price of 5,346. That is a $1,000 premium. If you're sitting in London or New York thinking you know the price of gold, you're looking at a mirage. The real price is being set in the retail stores of Shanghai, where people are fighting over 10-gram pendants because the bars are gone. This is physical scarcity manifesting in the world's largest consuming nation. Chinese mining stocks are hitting the daily limit up. They are soaring while Western miners sit flat. The smart money in the East knows that when the energy grid fails, hard assets are the only thing that retains value. They are trading their devaluing yuan for metal at any price. The West is trading metal for devaluing dollars at a discount. One side is winning. One side is being liquidated. Now, the question everyone is asking, if the war is escalating, why did silver drop from $94 to $88 in a matter of hours? You have to understand the regime dynamics. Now, silver is a dual-purpose asset. It is 50 to 60% industrial. When a war hits energy infrastructure, refineries, and LNG plants, the market price is in a growth shock. The algorithms assume that if energy prices stay this high, factories will close, AI data centers will throttle, and solar panel production will stall. Silver carries that industrial weight. In a growth scare, silver often lags, while gold leads. Gold is purely monetary. It doesn't care if a factory in Germany has power. Silver does. But that's only half the story. The other half is positioning. At 94 Farao, sentiment was at maximum bullish. Every retail trader on the planet was expecting a gap to $100. That is exactly when the heavy hands strike. They used the New York Open to gap the price down, triggering a cascade of stop losses. They used the growth shock narrative as a cover to hunt liquidity. Look at the largest holder of SLV, Jane Street, $1.3 billion. As I have told you before, don't mistake size for direction. They aren't investing in silver, they are extracting edge. They profit from the chaos of an 8% dump. They want you to panic sell your physical bars back to the dealers so they can restock the vaults that are currently draining. It is a rinse and repeat cycle, designed to keep the physical metal in institutional hands and the paper losses in yours. So what do we do when the screen turns red during a war? We look at the tape. Pull up your hourly silver chart. Add the 150 exponential moving average, EMA. When silver was slammed to $88 this morning, where did it stop? It found support exactly on that 150 EMA. It hasn't broken. It bounced back to $90 within the hour. That level is the Alamo. As long as we hold the 150 EMA on the hourly, this was nothing more than a liquidity raid. If we lose that level and fail to reclaim it, then we're looking at a deeper flush to $84, $90. But look at the Shanghai premium during the slam. New York dropped to $80, but Shanghai stayed at $102. The premium actually widened to $14. Now, the arbitrage war is accelerating. Right to the east is saying, thank you for the discount. They are using the New York slam to accelerate the drain of the COMEX vaults. Your protocol is simple. Ignore the headlines. The drones are real, but the price action is a simulation. Watch the vaults. If the registered inventory continues to drop while the price is slammed, the short squeeze is actually getting stronger, not weaker. Trust the premium. When the gap between the real price, Shanghai retail, and the paper price, COMEX, exceeds $10, the system is breaking. You are an apex predator. You don't trade on fear. You trade on the divergence between lies and ledgers. The majority are panicking because they think $88 is the value of silver. You know, $88 is just the price of a paper promise that the COMEX can't keep. March 2026 is the month where the invisible hand of the market is being forced to show its cards. They can suppress oil while the refineries burn. They can slam silver while the vault's empty. They can crash the e-commerce platforms in China to stop the gold rush, but they cannot manufacture 550,000 barrels of oil a day, and they cannot manufacture physical silver out of thin air. I want to hear from you. Are you seeing the $1,000 premium on gold at your local dealers? Is your shop out of silver bars? Give us the boots on the ground data in the comments. We are the intelligence network the mainstream refuses to build. Hit the subscribe button. Turn on the notifications. The reset is here, and the data is your only weapon. Stay skeptical, stay prepared, and remember, the logic will always outlast the hype. I'm out.